Hello. We're going to go through and finish the second half of Chapter 4, and this time we're going to be talking about the closing process. In Part 1 of Chapter 4, we talked about financial statements, but now we'll talk about the closing process and how we do it. I'm on page 219 right now in your textbook or in your ebook, whichever one you want to use. And so this talks about the closing process, and it tells us the closing process, it zeroes out all revenue accounts and expense accounts. So what we're saying is any accounts that are found on the income statement are going to be zeroed out. And these accounts in the income statement are your revenue accounts and your expense accounts, and they are known as your temporary accounts, also called nominal, but they're called your temporary accounts. And so what happens, and it tells here in the margin, the closing process, the temporary accounts. What we do is we go through, and whatever the balance is in these accounts, then we make a journal entry to the other side. So like a revenue account, because its normal balance is a credit, that's what you expect its ending balance at the end of the year to be, is a credit. So what we do is whatever that balance amount is in a revenue account, in any account that we're closing, we go through, and whatever the balance is, then we make the opposite entry in the journal entry. So if we're talking about a revenue account, it's got a normal credit balance, so that means I'm going to debit it. And then that gets the balance of that account to zero. Because what we do, and it tells us here, it says a step in the accounting cycle that occurs at the end of the period. The closing process consists of journalizing and posting the closing entry to set the balances of the revenues, expenses, income summary, and dividends account to zero for the next period. So that's what we're about here, is we're going to be setting these accounts to zero. And let me go over to page 220. It talks about permanent accounts. Permanent accounts are the accounts that you'll find in your balance sheet. These would be your assets, your liabilities, your stockholders' equity. So permanent accounts are not closed. They keep their balance, which makes sense if you think about it, because we're dealing with cash and other things that, of course, we want to continue to have our cash. Okay, we have to use an account that I call a crutch, but what it is, income summary. And it tells us right here, it's a temporary account into which revenues and expenses are transferred prior to their final transfer into the retained earnings account. So the income summary, we only use this account, and this is not the income statement, which is your financial statement. This is the income summary. It is an account that we only use it one time a year. It has a zero balance when we start. It has a zero balance when we finish. And they call it here in the book, it's like a little temporary holding tank, which makes sense because what we're doing is we're using it to be either the debit or the credit in the journal entries as we close. So here's a visual, if you want a visual of the closing process. And we have 4 closing entries. The first one, we're going to close the revenue accounts into the income summary. So that's what it's depicting here. This one, we're going to close the expense accounts into the income summary account. So that's what it's showing. With then the third journal entry, we're going to take whatever the balance is here in the income summary. In this instance of their example, they had net income, so they had a credit balance. So the journal entry for this third one, then we would debit this account, credit the retained earnings. This is the way that our net income and dividends are posted into retained earnings. This is the way our retained earnings balance increases or decreases over the years of our organization's life. The fourth closing entry is when we're going to close dividends to retained earnings. And let's go over to page 224 so you can get a look at some of these journal entries. Now, first off, let's remember, because we'll go straight in and look at that. Revenues, we're going to close the revenue accounts, which would have credit balances. We're going to debit any revenue account that we have, and we're going to credit the income summary account. So let's go over and take a look at it and see how it looks in the journal entry. And here it is. This company, they only had one revenue account. You might have 10 or 15 revenue accounts. But if you did, you would list each one, show their balance, and then income summary would be credited for the total amount. And that's what's happened here with the second journal entry, the second closing entry. Look at this. They have listed all of the expense accounts. You don't lump them. You list them separately because this is going to be posted into each individual account. So you list each account, and then this number, this is the total of your expenses. If you went back and looked at the income statement, you'd see this number in the income statement and all, because this actually is reflecting your income statement. Here we're closing revenues, here we're closing expenses. So these total numbers are what we saw in the income statement. Now, if you remember the purpose of the third one, you could go back and look on page 220 if you need to, but the purpose of the third closing entry is to take the income summary account and close it to zero. Now, I think they have this, yeah, they have an exam. They have it illustrated here. So here's the income summary. This is the first closing entry. They had the $17,500. The second closing entry had the $8,950. And notice then there's a difference between these two of $8,550 credit. We have to close this income summary account to a zero. So the way you do that is whatever your balance is, then you're going to come over here to the other side and you're going to make that amount entry. So let's go back up. The third journal entry is going to be a debit to income summary, and then we close this into retained earnings. And so notice it's a credit in retained earnings. Let's go back up and look at it. Here it is. Income summary is debited for $8,550, and retained earnings is credited for $8,550. This is our net income number. This is the way it's moved over into retained earnings. The fourth journal entry is dividends. And dividends, its normal balance is a debit. And so notice here, for us to close it then, we credit this account. And we don't use income summary for this one. We actually close this directly into the retained earnings account. So here's the debit. We're going to debit retained earnings, and we credit dividends. This makes sense if you think about it. Retained earnings is where we show what our net income is that we have kept. So we can either retain our earnings or we can pay them out in dividends. And so retained earnings is where we keep this information. This amount was our net income, and this amount is the amount that we paid out into dividends to our stockholders. So what we kept, what we retained, is this $3,550 balance. This would tie to the statement of retained earnings. This is the amount of our retained earnings balance on that statement. Okay, I hope this helps. Again, please, 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 if you need help, let me know. Send me an email, or if you'd like to, send me your telephone number and what would be a good time for me to call. I'll give you a call and we can talk about this and help you with it. I don't want anybody sitting out there feeling like they're on their own, because you're not. Okay, you have a good day. Bye-bye.